The reason we face that skepticism often is because of where the automobile industry is right now. It's very mature. It's not growing. In fact, we believe it has peaked. And that means all cars are in secular decline if we are right that we are moving into more of a ride sharing, both human driven and autonomous during the years ahead. So this idea that electric vehicle sales could grow at an 82% annual rate, just not going to believe it. And so that skepticism festers, especially, I would say, among institutional investors whose analysts on the auto sector, for example, are mostly value analysts. So there are a lot of those disconnects in the world that are creating great opportunities for us. And so I wanted to say that at the outlet because Will is onto something. You know, there are trends evolving here that are really fostering a lot of skepticism, especially the growth rates and the sustainability of the growth rates. But our research based on Wright's Law gives us an extreme sense of confidence that we are on the right track and that truth will win out. And the other thing I think is going on, and I do think this is going on, we have noticed and our intermediaries have noticed that there's been elevated options activity in our funds, both on the strong days and on the weak days. Well, that probably is the case. And here I'm going to give you a sense of why I think that's the case. I think that there is a big difference between the way institutional investors look at investing and retail investors. I mean, we know that the Tesla example is a good one to illustrate the differences. And I know there was a lot of frustration, and it seems to have been pent up over many years about Tesla and you know, our research on it. Lots of fear, uncertainty, and doubt with which we had to contend. But we thought it was a good thing, the debate. A lot of institutions are not set up actually to analyze a stock like Tesla. And I'm not saying all institutions, but I'm saying most institutions. And the reason for that is after the tech and telecom bust 20 years ago, almost to the day, March 10th, it started 21 years ago. And then on top of that, the 08-09 meltdown in the equity markets and the bond markets, there developed a lot of risk aversion, and volatility became a bad word. We have a volatile strategy, and we use that volatility to our benefit, trading around positions. Volatility is not a bad word in a bull market. Volatility, you've seen what happens in a down market. What has happened is institutions tend to be very benchmark sensitive. And I'm going to use Tesla as an example here. Tesla, as you know, many of you know, did not enter the benchmarks until last fall, when it was over $500 billion in market cap. So there was a lot of there were a lot of investment returns to have up to that 500 billion, and we were happy to be there. And we're happy that institutions are joining us now, but they're joining us primarily because Tesla entered the indexes. I'm not sure they really are trusting this. And the reason for that is their auto analysts tend to follow the traditional auto industry. And the traditional auto industry is very mature. And as I mentioned before, we think it's in decline. And we are focused on exponential growth opportunities. We believe a subsegment of the auto industry is going to see exponential growth for the first time in 100 years. And so that's our sole focus. Institutions have hired analysts to focus on an industry that is mature, and now there's a transformative really revolution taking place that will alter the auto world completely. There was a lot of skepticism. The auto industry itself didn't expect electric vehicles to amount to much of anything I think they thought it wouldn't take until the mid-20s. Well, it's here. And we began to invest aggressively in this space on that assumption as we saw battery pack system costs decline as rapidly as they have been declining. And so I think that kind of tug of war between the traditional backwards-looking world, which is based on benchmarks, and certainly the top positions in benchmarks are where they are because of past performance. ARK is focused on the future, especially on the future that involves transformation. And so benchmarks, I think, have been an impediment, and setting up research organizations in the way they've been set up is also an impediment to some of the new ideas. The other difference between what ARK is doing, what a lot of retail investors focus on, is time horizon. I know that institutional investors are much more short-term, many, not all, and they're very focused again on the benchmark. So this idea of being graded every year based on how well an analyst or portfolio manager did relative to a benchmark is quite constraining. The luxury we have, and retail investors have, is retail investors really don't have career risk. We might have a little bit more of that, of course, given what we do, but we have a 5-year time horizon. That is a luxury. That's a luxury. And the difference between linear growth and exponential growth in the early years, when electric vehicles are at 500,000 a couple of years in sales globally, last year 2.2 million. In those early years, because the bases are so low, there doesn't look on a graph to be that much difference between linear growth and exponential growth trends. You give that a few more years, and the difference is quite surprising. I mentioned that 82% growth rate. We really believe that's going to happen, especially now that China is pushing hard. I don't think traditional auto analysts still believe